Hello, everybody. This is John Browning on the Building Your Life podcast. And today I have with me is this the second or third time, Bruce, that we've had you on? I think it's the second.
I think second on your show, and you've been on my show a couple of times.
I've been on your show a couple of times. So Bruce Weinstein of Weinstein Wealth, he is the plan man. And Bruce, I'm going to let you introduce yourself and tell us a little bit about even about your podcast. It's not quite as good as the Building Your Life podcast, but we'll let it give it a pass, right?
Who can match? Who can match? Thanks for having me back, John. So yeah, I've been licensed in the financial securities industry since 1986. We've helped hundreds, if not thousands, of clients in the financial planning world, investments, insurance. And so I was trying to find a platform to share and give back to the world, and in some sense, print up a legacy. For me, that the day I'm not walking this planet, that what's in my brain can be bestowed and shared upon the audience. So we created Ask the Plan Man. Everyone deserves a plan in life, and we talk about various topics of insurance, finance, and more. It's business planning, exit planning, estate planning, retirement planning, college planning. There's so many things planning is about. Vacation planning. So we each week we do different segments of, do I lease a car or not lease a car? How do my credit scores get impacted? And so we've got all kinds of topics, not just about life insurance or long-term care or health insurance. And people like you talk about investments in the markets, but we try and bring different financial-based topics that people can listen to and self-educate, and then contact you or I if they, need some help. So
yeah,
I guess it's you and me. I got to fix that. You and me.
We'll forgive you. This is not a grammatical podcast, so I think we're all right. So
we're not English students; we're finance people.
That's exactly. Yeah. Ask us some numbers questions or something like that.
I before E, except after earnings reports.
Earnings reports, exactly. Well, Bruce, I like the fact that you are the plan man on building your life. That's what it's all about. It's about, what do you do? Is it all about the money? Is it all about the portfolio? We say absolutely not. The portfolio is the tool. The money that you have is the tool that you use to create the life that you want. And in order to use that correctly, you need a plan. You need a plan for everything. If you're going to be very successful and recently you've lost a lot of weight, you've gotten a lot healthier, right? You had a plan for that you followed, and you're still following, right?
Right.
And it's really all about that. If you want to get in shape, if you want to lose weight, if you want to go on a nice trip, the more you plan for that trip tends to be, at least in my experience, it tends just to be a better trip, right? You know where you're going to be, you know how to get there, and you build out the map. But really today, because of your experience and my experience on Wall Street, I wanted to talk to you a little bit about things that Wall Street really doesn't want the average individual on Main Street to know. And I know you've got some stories because of your experience on Big Wall Street, and so do I. But the first thing that comes to your mind when you think about things that Wall Street doesn't want the average individual to know, what do you think?
Well, so it goes back to my early days at a brokerage firm with the initials ML. Okay. And I was a young account executive, as we were called, and they were pushing a stock that was highly touted, rated secure dividend. Basically, it was so highly rated, it was considered like safe for the little old lady. Because we have this suitability that we always have to, is this right for the client? Right. And so it was the highest rating they had. And a couple months later, they went bankrupt.
Interesting.
Not just dropped, bankrupt, like just totally vanished. And my clients were up in arms. Now, I only had a handful of clients. I was just starting in the business, but it got me to realize that my clients were being treated as a distribution channel. That sorry, I didn't say that, did I? That ML's institutional investments, their portfolio managers, whoever it was, had this position of size, and certainly were seeing something coming down the road and needed to offload it. And instead of taking it to the street and just dumping millions and millions of shares to the market, which would have driven the price down, they just recommended that our clients on the retail side buy it. And we had an incentive. We got an extra commission kick out of it, which was allowed back then, and now it's been, removed. So where you get normal commission, we had commission plus 8%. So it was paid out at 108. So you got a little juice on it. So they want to know you're going to go out and push that stuff. So yeah, I got paid a little extra. I put some clients in it, and guess what? All my clients lost their money. So instead of Merrill Lynch losing the money, or the institution, the institution, the management doing it, or dumping the shares on Wall Street. Now, remember, if the listener that doesn't understand, if I have 10 million shares of a position in a portfolio, I can't just take that to the street and dump 10 million shares without the price getting hammered. Because now everybody knows there's blood in the street. Somebody's unloading that position. And now other people are going to go, well, maybe I should be getting out of my position. And the selling frenzy it's like sharks. And so the buyers are going to disappear. And so they used their own client base to offload the stuff because we were keeping the prices inflated. They were just selling you their shares out of their portfolio. They weren't taking it to the street. They were just filling your order out of their own inventory and getting it off the books, which, later on was deemed to be pretty illegal.
Pretty illegal.
Tad,
not completely illegal.
Tad.
Just a little bit illegal.
Yeah.
And that's a great point. I mean, some of these activities have been cleaned up, right? And I say cleaned up in that you can't do things that way anymore. Here's the thing with Wall Street, and I came along a little bit behind you. Not that you're that much older than I am, but I was about 10 years.
Seven.
Yeah. 10 years behind you. And so I kind of came up in the 90s, and that was sort of right after that was just rampant. That's when the Wolf of Wall Street, happened and all that. So in the 90s, it was really interesting to me. And I was young in the industry, and I didn't necessarily catch on right then. Now looking back, it's very clear to me how these are all smart guys, right? Smart guys, smart gals. And they were trying to figure out ways around. We can't do it this way. So how can we do that?
Yeah. The words exploit. Everything with Wall Street and the term arbitrage is to exploit some gap in the system. So it doesn't matter what rules are in place or what's considered to be right or wrong. If there's an area that they can exploit, until they get caught, or it's now that gap is closed that they can't exploit anymore, well, it's buyer beware. And so you're getting engaged with people who are always looking for the angle to capitalize on somebody else. The problem with Wall Street is it's not win-win, it's win-lose. When you sell, somebody has to buy it. When you're buying, somebody has to sell it. So there's always a person on the other end of that transaction. So it's a sum zero game. You and I both can't win. Somebody's going to lose if we enter into that transaction. So you're selling it, hoping it's going to go down. I'm buying it, hoping it's going to go up. Well, only one of us is going to be right.
That's right. Yeah. And this is why I like what you do and what I do. Obviously, I like what I do, right? But we're both independent advisors. We both have our own firms, and we're fiduciaries. We are truly working for our individual clients. Whenever you work, and I spent years, I am so happy that I spent years on Wall Street, because I got to learn from some of the best minds in the business. Right. I learned almost everything I know in big Wall Street. So I can't get too upset with them because of what they taught me. But at the end of the day, who are they beholden to? Are they beholden to the shareholders, where they're trying to make the company more profitable, or are they beholden to the clients and making more money to the clients? It's a really tough place for anyone to be, right? Sure. Because they can get in trouble if they don't have their clients' best interest. They can also get in trouble for not having their shareholders' interest in mind.
It's definitely a seesaw of balance of how do they serve two masters, and it tends to be more at the retail client's expense historically. You mentioned before, I'm thinking like the Wizard of Oz, like you peeled back the curtain, Toto peeled back the curtain, and there's the guy. So you and I have been around long enough that we saw behind the curtain. And I think the biggest thing that we do for our clients is let them know what they're up against. And so you and I do business differently than most people because, as I did as a young advisor, is I did what I was told. That's
Yes.
what they wanted. They didn't want you questioning authority. I used to get challenged. How come you're not selling whatever the product of the week was? And my response was, well, I don't think it's good for my clients. Well, the manager was like, I don't pay you to think, I pay you to sell. Now go
Mhm.
sell it. I'm like, no, because after I got burnt on that one stock, I was much more cautious on what I put clients in because it's costing me business. It's my reputation. At the end of the day, when I left that company, I had clients that didn't want to leave the big box firm because of their reputation. And then I was blamed for the stocks that they lost on. And I'm like, you don't understand. Like, they stuck that in your accounts. They told me to tell you to buy it. Now I know not to do that. That's why I'm leaving this firm, is because I don't want to be associated with a place that's out for their own interest and not my clients. I'm here for you. So I was always in the consultative sales role. And after getting burned a couple of times with the products that they were pushing, I'm like, no more for me. I'm going to be a free thinker, and I'm going to do what I think is best for the client. And guess what? I was the salmon swimming upstream for many, many years.
And I think, one of the things that I used to do is I was a portfolio manager on Wall Street. And so I would go out and I would speak to financial advisors, and I would maybe sponsor a dinner, or I would do, something like that. It was to their benefit. And suddenly I would get more funds flowing into my mutual fund, my unit trust, my whatever, or my exchange traded fund, whatever it was that I was managing. Again, you run into, and it's not like I don't get it, I get it, but that's what would happen. I would get funds in, and it was a common thing to know that in the portfolio management on Wall Street, that when you saw retail moving heavy into a particular fund or a particular sector, well, we knew that was time for us to go over here and invest and sell this one, because the marketing machine of Wall Street is so powerful, right? And they being big Wall Street will push in one direction, all the while, to your point, their funds may be going somewhere
Right.
else. Right. So
Well,
that's one thing that I think, as an independent advisor now, I have as an advantage, because I see that happening, I understand it, and I can steer my clients in the right direction.
you're to your point, we've been around the block to see 4, 5, maybe even 6 market corrections in the last 30 plus years.
Right.
And so, one of the lines that we always say is getting in is easy, getting out is hard. And the problem is, when you use individual securities, what's your exit strategy, right? We're back to the plan, man. What's the plan? If I'm buying Tesla at 100, what's my exit strategy? Am I looking for Tesla to go to 120 and I make 20%? Am I waiting for Tesla to go to 2000 and I make 20 times my money? And so it's just a matter of what's the timing, the horizon. And then when it starts to get to those elevated levels, well, now getting out is hard. Do I sell it at 120, or do I wait for it, at 2000? And then, of course, it goes hyperbolic. And then you and I deal with what's called FOMO, fear of missing out. And you see stocks go crazy. And our historical wisdom, not that we're the smartest guys on the street, but we've been around enough to know something's fishy, like something, it can't go on forever. And so the biggest problem I encountered and caution clients on Wall Street is, nobody's ever going to tell you to sell, ever. Because, as we just discussed with that early stock piece, is it's a greater fool theory. And so it's musical chairs. And when the music stops, somebody has to be left without a chair. And so when I want to sell XYZ stock, well, I need people to buy it from me. So if I'm trashing it, if I put a sell on it, if I'm recommending unloading it, well, then that's like somebody yelling fire in a movie theater, and only one person can go out the door at a time, and there's 75 people that have to get through the door. Somebody's going to get stuck inside, right? Somebody's going to own the stock at 75 cents when other people got out at $90, and that's Lucent. right?
Right.
So the inherent conflict of interest, whether it's been cleaned up, tightened up, improved, but the inherent conflict of interest people just don't understand is your advisor is never going to tell you to go to cash, ever. A, they don't get paid to put you in cash. B, their companies are not going to let them charge their fees for you to sit into cash more than 90 days. And so, the adverse conversation is, we can't time the market, so you can't keep getting in and out and in and out. And I'm a purist in that sense as an asset allocation manager, but people just don't understand. Like, what's the hardest part of going to the casino? Stopping. You win a couple hands in a row, you hit a couple numbers at roulette, you throw the dice and hit it. The hardest words to come out of somebody's mouth in the casino is, take me down, cash me out. Because they get you drinking, they're giving you a room, they're feeding you, you want to keep playing, there's excitement, there's a thrill, you're hitting, you're splitting aces, whatever. But guess what? At the end of the day, like, you stay there long enough, your money is given back. And so it's the same thing with your investments, is when is enough, and how do you temper your risk associated with your age and your needs? And, this is why you and I are in business, is to help people mitigate through all of this, because it's clearly not easy.
Right. I like and we usually don't mention individual stocks on Building Your Life. And this is not investment advice. Please do not take this as personal investment advice. Call me, call Bruce. He's got Text the Plan Man, 321-421-5213. You can get a hold of him if you don't like me. And of course, you can text the word life to 21,000 if you want to get a hold of me, and we can give you personal investment advice once we get to know you. But this is certainly not that. And full disclosure, I do own Tesla stock. And we own it in client portfolios, and I own it myself. But just to use that as an example,
it was just a conversation piece. It wasn't.
Yeah, it was just a conversation piece. But just to further that conversation, as Tesla has gone up and it's gone way down, and it's a very volatile stock. One of the hardest conversations that I have had over the past year or so was, as it went up, it's time to trim. It's time to sell, not sell the whole position. Still a good company, still making money, we still like it, but to trim that if it's appropriate for their portfolio in the first place because of how volatile it is. And portion control. It's like when you go to try and lose weight or something like that. It's not about not eating. You don't go on a fast for, you might, but that tends not to be healthy, right? And so you don't not eat. You practice portion control and what you eat.
Correct.
Both of those two things. It's the same way with portfolio management. If you had trimmed a little bit off of Tesla and some of those other highly volatile but stocks that did really, really well in 2020, 2021, and you put those into a little bit less volatile stocks, well, you would have actually done better than the very conservative portfolio and the highly volatile portfolio. But it's such a hard conversation to have because when you're going up, nobody wants to sell, and when you're going down, oh no, I can't sell now. So that's a big part of what we do in the planning process, is we introduce that discipline and how to do that portfolio management.
So the big piece for me is labeling it as, I'm an asset allocation disciplinarian. Asset allocation is a disciplined approach to managing the money. It takes the emotional side out, which is where most people make their decisions. They have FOMO, fear of missing out. They go chasing things, looking buy high, sell higher. When you and I know, and Warren Buffett knows, is when nobody wants it, that's the time to buy it. When there's blood on the street, that's when he makes the most money. So what that means is buying things that are out of favor and going against the herd in a downward fashion, and identifying that that's the opportunity to buy when most people don't want that. So asset allocation is a disciplined approach of how to sell high and buy low over periods of time to keep your risk modified to what is appropriate for that person's situation. Because if you all of a sudden owned nothing but Tesla, that is a major amount of risk And it's not that you couldn't make money. It's not that you didn't turn 100,000 into 5 million. But if you don't know when to get out and something negative and adverse happens and suddenly they're filing bankruptcy, and I'm not saying they're going to, this particular company, but I've seen it in the past. You've seen it in the past. So here's an example. You and I have a particular colleague, I won't mention names, that was very heavily involved in the crypto space and literally turned $10,000 into $1 million. And deemed to be, I'll use the term loosely, not their word, they viewed themselves as a genius of knowing all about crypto and how easy it is to make money. Well, then it shifted. And all I kept asking them was, are you taking some profits? What are you doing to sell? Oh, no, it's going to keep going higher. We're getting checks every month. And, again, blinded by reality that you turn 10 grand into $1 million with the perception of, I'm going to keep risking $1 million because it's going to turn into 2 million and to 3 million and to 4 million, instead of ever saying, well, what if it does stop? What if it goes the wrong way? And so as it played out, and I would inquire over time, well, how's it doing now? How's it doing now? And eventually was told that they sold for about a $70,000 profit, not 700,000.
Right.
They allowed it to drop over 90% before they said, that's enough. We got to get out. And they could have sold on the way up. They could have sold on the way down. There was zero discipline or notion of how to exit the position successfully. Now, at the end of the day, you could say they made 6-7 times their money, but clearly they're disappointed and devastated. And by the way, this particular thing went bankrupt. So it's a good thing they took out what they had. But again, oink, oink, goes the pig. Is, we say bulls make money, bears make money, pigs get slaughtered. So you can make money in an up market, you can make money in a down market. But when you're a pig, you're going to get slaughtered at some point because you just lack the discipline. And that's where John comes in, is to give it discipline and manage the money so that you literally have no more than 4 to 5% exposure of any one particular position, so that if it went south, I don't want to curse on your show, but we use the term SHIT, the bed, right? If you wake up in the morning and the stock crapped the bed, basically means they had a negative earnings surprise, something detrimental happened. The country they're in, got overthrown and now is
Right.
A national, the stock's gone, right? So it crapped the bed and now it's worthless. There is no way to get out. Overnight, it just collapsed. And so if it's no more than 2 or 3% of your portfolio, are you going broke? No, you'll recover. You'll find something else and you'll make it back. But if it's 60% of your portfolio, we call that a bad day. Like you're
That's
devastated. Yeah.
So the bottom line is there's Wall Street and the Bitcoin folks are rarely, if ever, going to tell you to sell. Right? I don't think I know a Bitcoin guy or gal on YouTube, LinkedIn, or anywhere else that has said sell anytime during the last, we've seen that go from from like 60 some thousand. I think it even got higher than that, right? Bitcoin itself, BTC. And now it's down where, in the teens, I believe.
I don't look at it every day, but I think it's back over in the mid 20s again,
Yeah,
because the market's rallied a little bit. I mean, again, I don't timestamp your show, but the markets have fluctuated. But I may have shared this on your show previously, so I apologize if I did. But a year and a half ago, I captured a screenshot on my phone from a CNBC alert that Goldman Sachs was now offering their retail clients access to cryptocurrencies, i.e. Bitcoin and all the others. And on that particular day, Bitcoin was $59,000 a share, a unit, a coin. Okay. Now, again, this is February of 2021. Now, my understanding, because I've had some Bitcoin, NFT, blockchain people on my podcast, and we break into that. Like, this stuff's been around for like 8 to 10 years. This is not an overnight sensation, that it has just been morphing and building over time. But understand that that coin was $10, it was $100, it was $1,000. And nobody was letting John and Bruce play. We couldn't get it unless I set up my own mining farm, whatever that means, and I went and harvested my own cryptocurrency. I had no way of getting access to it. And yet these people did. And it goes from 1,000 to 2,000 to 5,000 to 10,000 to 20,000. And now all of a sudden, FOMO, people are like, well, I got to get some of this. It's 20,000. It was 100, folks. It was 100. And now it's 20,000. It's 30,000. It's 40,000. And more clients are like, how do I get in? And I'm like, I have no idea. I have no idea. I don't know how you get in. And it's 50,000. And so now at 59,600, or I don't even know what the 600% return, 6,000% return. Somebody who paid $100, it's now worth 60,000. Now they're going to let John Q. Public play. Does that sound like the stock that Merrill Lynch was trying to unload in 1987 that nobody else wanted? Well, now I need my distribution network. Hey, come on in, folks. I'm opening the doors. You can have all you want at 59,000. They suddenly figured out how to give it to you. No, they suddenly decided they want to give it to you.
That's right.
And now they're giving it to you. And so they fed it out. And just to finish, because you already alluded to the fact that it's already crashed, it did go up a little bit more, maybe into the mid-high 60,000 range. And then pretty much it's rolled over. So whoever got in then maybe made 10, 15%, and then it shit the bed. And then it just, right? And so if you're in at 58,000, 59,000, 62,000, and it's at 20,000, you lost 2/3 of your money. And guess what? People buy it on margin, which means they're leveraging. They didn't put up all the capital. You and I have run into people that, put $50,000, $60,000 and they're down 50, 60, 70%. And then the question is, well, what do you do from here? Do you ride it out? Do you leave it? Do you walk away? Because keeping it at 20,000 is still a decision. I could put that 20,000 in this case. Let's just use Tesla again. Am I better served having that 20,000 in Tesla moving forward or leaving it in Bitcoin? So everything, buy, sell, or hold, everything is an investment decision. So you are allowed to assess and redesign your investments based on where you think the next opportunity is. So if it's dead money, get the heck out of it and put it somewhere else. I can't tell you if Bitcoin's going to go back to 100 or it's going to go back to 60. I have no idea. Now, I'm rambling on you here, but if it's 2% of my portfolio, I can afford to let it go. If it's 70% of my portfolio or 100% of my portfolio, I'm hitting the panic button somewhere well before 20,000 because I realize I just made a huge mistake and I'm getting clobbered.
Right.
So what do you do? But to the point is, I'm golfing on Saturday, and one of my golfing buddies said, "What do you think about gold?" I'm like, "It's shiny." I'm like, in what sense? Well, is it a good investment? I mean, it's a deeper conversation. But my standard answer when anybody asks me questions is, it depends. Because you and I are financial doctors, and we're not going to just give somebody a quick recommendation until we understand what they're trying to accomplish and understand their risk and their timelines and assess their situation. That's the planning. So when a guy says, "What do you think about gold?" Well, I got a million questions. Now we're golfing, so how am I going to get into a deep dive with him? But I'm trying to explain to him, like, gold's a hedge, it's against inflation, depends how much you have. We've used it historically against fixed income portfolios, but I said it has its place, but to what percent?
Yeah, in proportion control, right?
Right, proportion control. Like, I love desserts, I love ice cream. I can't eat ice cream every day and try and keep losing weight. I can have it once a month, I can have it once a quarter, but if I'm eating a gallon of ice cream every week, I'm not going to lose 59 pounds.
That's my problem. Bruce, you never told me that. That's my issue.
John, now you and I both know that gallon of ice cream is not a gallon of ice cream anymore. It's, I sent you pictures.
Yeah. It's like 2/3 a gallon or whatever it is now.
That's a whole inflation conversation of how the system is trying to fool us.
Trying to fool us into thinking that ice cream really hasn't gone up that much in price when actually getting less of it. Well, Bruce, let's wrap this up. The whole point of this show is that, please call us. We're free to talk to, and we really do have your best interest in mind. My goal, my mission since I left Wall Street is to help people build their lives, not just their portfolios. And one thing I can't do, and this is the decision that has to be made, one thing I can't do, Bruce can't do, is we can't make that decision to make that phone call for you. So text life to 21,000, text Plan Man to 321-421-5213 and get a hold of us, or just go out to www.guardianrockwealth.com and hit the contact us button, or listen to more podcasts if you haven't quite decided you want to talk to me yet. There's all kinds of information there. And Bruce, is there other ways that they can get a hold of you as well?
Yeah. Let me just a couple of things. So don't go it alone. That's what you and I always talk about, is don't go it alone. And then at the beginning, when we talked about build a life, not just a portfolio, is I use the acronym Woody Woofy. What do you want for yourself? And so if you can identify that, whether you're working on your own or with a professional, what do you want for yourself? What are you trying to accomplish? Well, gee, John, that sounds like a plan. It's a roadmap. What we use, the terminology is, you and I are their navigators to help them get from point A to point B, whether that's plan for their kids' college, plan for their retirement, plan for their estate, whatever it is. And that's what the Plan Man's all about. So, what's your Woody Woofy? Don't go it alone. And so, yes, thank you. You can reach us at asktheplanman.com. You can call 844-PLAN-MAN. And as you've alluded to, we've got the podcast, Ask the Plan Man, on YouTube and all the podcast channels. We do a weekly show. We talk about all kinds of different topics, insurance, finance, and more.
All right. Well, thanks everybody for joining us on Building Your Life with John Browning. And thank you, Bruce of the Plan Man, for joining us this time as well.
Thank you, John. Always a pleasure. I enjoy our conversations.
All right. We'll talk next